Fios is not cable. We're wired differently, which means you can get the fastest internet available with equal upload and download speeds from 50 to 500 megs. So you can upload 200 photos before your favorite song is finished. Click the ad and switch to Fios today to get our best offer ever.
This is a download from BFM 89.9, the business station.
Good morning, George. Hope you're there. I just want to get some review of October. It was a really good month. The Dow Jones jumped about 10%. This is the biggest monthly gain since October 2011. Could you take us through what were some of the factors that drove this big gain?
Yes, Julian, good morning. Yes, the market has had a remarkable rally. When you take a look, the first thing that happened was what didn't happen, which was the beginning of an interest rate increase, which theoretically was expected in October and September and didn't happen. That gave the market a reason to expect a further delay in interest rate rise, which gave more of an impetus for growth in stocks. It's been a remarkable rally. It's one thing to underperform in a down year, but now that we are positive for the year, and B, we are in a definite technical uptrend, it's much more difficult to be out of the market when you have that kind of scenario. So it's driven a lot of the players who've been on the sidelines or out of the market back into the market. And the fact that what helped was the unusual upside momentum off the low. That's really what got this started. And once you have that, it's very hard not to participate. So we do expect the market to continue its strength into the end of the year. If you look at where the real strength was, it's been in the NASDAQ 100 stocks, which means it's been focused in a relatively small group and not across the board. There have been various pockets of weakness. If you were in healthcare, biotechs, pharma, retail, you can see you will have felt some of the bear market tendency. So it's not a long-term prognostication that the market's going to continue. We do expect that at some point the end of the year will come, and then we will see more of a question as to whether there's enough strength in the market to go forward. And that question will be based on fundamentals, not on low interest rates.
So, Dodge, what is your outlook for the rest of the year? Is the market going to be positive, as good as October?
Maybe not as good as October, Julian, but yes, positive. It's going to be very hard, A, to be short the market, and so there won't be as much short interest as there has been. And B, it's going to be really a catch-up for a lot of the money managers. There was a relatively over-average surprise to this move, and the fact that there was such upside momentum on the expected downturn and that didn't happen, it's going to cause more of a momentum till the end of the year, Julian. But that's only to the end of the year. Until then, the questions are being asked, just as you're asking, are more positive than negative, and so it's going to be more market to the upside.
Now, the Fed also updated its economic model, which suggests a narrowing output gap. Now, this suggests a position of strength, and a lot of analysts are saying this will hasten a rate hike. Are you nudging up your own growth numbers?
Yes, Julian, we do. We're stronger in our opinion that the interest rate hike will happen in December, and quite frankly, if it doesn't, that will be an indication of weakness more than anything. In terms of the U.S. dollar, this is going to be something that will have much longer-term implication for our markets. We're looking for the dollar to keep rising worldwide, 5 to 7% more by the end of 2016 after a 17% climb in the 15 months started in mid-July of last year. So interest rates are, in fact, poised to go up. We expect the nod from the Fed in December. The U.S. dollar will be even more desirable option for foreign investors. Central banks in Europe, Japan, and China are moving rates in the opposite direction. But ultimately, Julian, the stronger dollar is a net negative for us, for the U.S. It widens the trade deficit and costs jobs and companies that sell goods overseas. The beefed-up dollar, along with the slowdown in China, will knock off about 0.5 percentage point in our growth next year. So we're expecting to see growth come in around 2.5% to 2.8%. So there is a much longer-term implication to what the Fed is doing versus the U.S. dollar.
Now, talking about that, the most worrisome economy right now, China. The Chinese yuan made its biggest one-day gain on Friday versus the dollar since 2005. Why is this happening despite expectations of a stronger dollar?
Well, let's say there are a whole bunch of things that are going on there. There's an indication that Chinese factory activity has slowed. It's an unexpected contraction in October. It decreases the hope that there will be a fourth quarter turnaround. The official manufacturing purchase index remained at 49.8 in October, and it's the third consecutive month below that 50 mark, and it comes amid signs that the government spending has yet to make significant traction. Now, on top of that, intervention support is coming in front of the IMF's forthcoming internal debate on whether to include in the special drawing rights. That basket is going to be very important to the future of China relative to the rest of the world. So I believe the central bank wants the yuan to show more strength ahead of the IMF decision. Particularly remarkable is the yuan is still tightly controlled by Beijing, but as China continues to take steps towards liberalizing the currency, we expect the yuan, or renminbi, to trade with more volatility and with larger daily ranges. And so this is part of the process that they're going to have. And then if you take exchange, there's a host of different things. You have to watch the offshore yuan 24 hours a day and much more freely than the onshore counterpart. That has gained with volume, but not as much. So it's taking time for it to filtrate outside of China. The PBOC set the official midpoint rate higher than the previous day. It was 6.3495 versus 6.3596. So we're beginning to see the People's Bank of China beginning to officially support a stronger yuan. The ruling party reiterated on Thursday night its goal of doubling its GDP over the decade ending in 2020. That comes in a very timely fashion. You have Germany and China creating a new yuan-denominated trading platform on the Deutsche Börse. All this is adding up. Oh, and by the way, the Bank of Japan did not expanding its stimulus program on Friday, and so there was a sense that there's a perception that there's not going to be an Asian currency war going on. So all this is part of the decision for China to support its yuan now, and the timing is quite appropriate given what the IMF is about to decide.
And over to Europe, the ECB stress tests reveal a $15 billion capital gap for Greece's main banks. Will this, do you think, dampen the European markets after the recent good news that was driven by their QE announcement?
Well, Julian, it's not straightforward. I mean, Greece itself has come a long way. Think of the concerns and the fears that we had not less than a year ago. Draghi, over the weekend, in a newspaper interview, reiterated his continued readiness to do what it takes to keep medium-term inflation on target. That comes at a time that supports the market, and then you take a look at Greece itself. Yes, there is an illiquid banking system, and the fact that it needs to rehabilitate its moribund economy is very important. It's focused on the four banks. The four major Greek banks have until this Friday to inform the ECB how they plan to cover the capital shortfall that you mentioned. The final deadline is set for year-end to avoid depositors in the private sector from being hit by the bail-in that is EU-wide at this point. It is hoped that much of that black hole that was discussed can be plugged by private investors and the existing bank bailout fund through a combination of share and bond purchases. So there is hope that that black hole that has to be filled is not going to be directly impacted with the EU. So, and also you have Germany coming out and indicating that the shortfall is not as bad as it was expected. So the perception that the Greek concern, the Greek tragedy that we're going through now, is not as serious as it was in the past, creates a more positive reaction to it and a more positive expectation for the euro currency and the EU in general.
Thank you. That was Dorland, CIO at Landor and Fuest Capital Managers in New York.
Thank you for listening to this podcast. To find more great interviews, go to bfm.my or find us on iTunes. BFM 89.9, the business station.
This year, I will chew 117 number 2 pencils.
I will doodle 9 Staples notebooks to death.
When it comes to school supplies, it's guaranteed your kids will go through a lot.
I'll make a whole lot of paper airplanes.
I will lose my backpack.
That's why you get guaranteed savings for back to school at Staples.
I'll give away my last pen to Nathan in math class.
Get guaranteed savings at Staples, and right now, 1 subject notebooks for just a penny with a $5 purchase. Staples, that was easy. Valid on select SKUs while supplies last. Limit 6, ends 8/25/12.